Welcome to this latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist of Sanctuary Wealth. Today, I am pleased to welcome our guest, Jim Cullen, who is Chairman and CEO of Schaefer Cullen Capital Management. Jim is the author of The Case for Long-Term Value Investing, a guide to the data and strategies that drive stock market success. Jim, welcome to the show.
Thank you for having me.
Oh, thank you so much for joining today. We have a lot to talk about. I do want to show our viewers, this is your book, The Case for Long-Term Value
Which
Investing.
matches my tie, by the way.
You totally match, totally. I love the color. You can't miss it on the shelf. And we'll be going to be talking a lot about what you wrote in your book today. So you've been on Wall Street 60 years plus?
Just about, yeah.
Can you tell our viewers a little bit what got you interested in investing? How did you wind up on Wall Street?
I started off in the Navy on an aircraft carrier for 4 years, and I was managing a small amount of money, which I'd done in college. And it was an easy time for the market. Everything just went up. I said, this is fun. So when I got out of the Navy and went to Wall Street, Merrill Lynch was just starting to hire guys like me. And I was a millennial. I didn't know anything.
So you were in your 20s?
20s. I was around 23, 24. And they had an investment class, which went for about 6 months or 9 months. I went through that and started off with they had a new office down right alongside this New York Stock Exchange. Well, it was a bonanza time.
So what period are we talking about?
This is 1960s.
Okay.
65. And then by 1968, it was really heated up. The conglomerates, which were a new investment vehicle, which were levered based on leverage, Gulf and Western and stock Litton Industries, what have you. The top trading stocks every day were that. Small cap stocks were the most popular. There was a guy named Charlie Plone, and he was doing 2 new issues every single day. The small, crappy little companies that were never worth anything, but the speculation was unbelievable. So in our office, we had about 20 brokers in the office, but it was so popular, every day at noontime, the thing was packed. And people were standing in line to open new accounts.
Wow.
And so it was really, unbelievable. Brokerage firms were opening offices all over the country on Main Street. And so it was just, boom time. A little bit what we've seen throughout history in different times. And Wall Street, there's no moderation. It's either one extreme or the other. And this was the one extreme. I thought it was the only extreme. And actually in 1968, the New York Times did a study, an article on the front page, pointing out how the market approaches 1,000 for the first time. And so it was myself and 2 other guys in our office were on the photograph on this article, dial 1,000. And little do we know that didn't go through 1,000 then. Not only that, but it didn't go there for the next 14 years, 15 years.
So you started your career in a bull market.
In a bull market.
And then you were faced with,
Reality.
a bear market. You entered a bear market.
Yeah, 1968, the market rolled over. It was the worst bear market since 1929. Then you recovered. All these conglomerates went out of business. Charlie Plone went out of business. All the speculators were wiped out. The margin accounts were all wiped out. And so we thought that was the end. But the market rallied, and the institutional firms like Morgan Guaranty were at that time saying, well, listen, those guys are speculators, traders. There's a real market. The real market is high quality companies, IBM, Xerox, Eastman Kodak, and stocks like that. You can buy those, and that's investing. So they started buying those stocks. So the market recovered in the 70s.
So that was the Nifty 50.
That was the beginning of the Nifty 50. And then I went over from Merrill Lynch to a firm called Spencer Trask, which was one of the leading institutional firms at the time. And I was working with the hedge funds and what have you. And we were doing research reports, which were about 60 pages with this fancy blue stationery and recommending all these stocks. And so we had our research director there at that firm, top research person on the street, came out and said, these are stocks, which you'd call them deserted island stocks. You can go on a deserted island and come back 2 or 3 years later, the prices are always going to be higher. So it doesn't matter what you pay for them today because their potential is so
So
phenomenal.
value didn't matter.
Not at all. The potential is so phenomenal that these things are going to be worth, a lot more than you paid when you come back. Turns out he was wrong. 5 years later, these things were down 50%. And actually, that was begin 75. So we talked about 68 to 75, and the market made new lows. A lot of the brokerage firms are going out of business. All those offices on Main Street were being shut down. Our office on Wall Street was merged with another office and consolidated. And so Wall Street was a ghost town.
So that's the pendulum that you were
75.
talking about. When the times are good, they're really
Yeah.
good. But when they get bad, it's really
It was a
bad.
ghost town. And so I knew this institutional thing, the high growth stocks wasn't working. And
Did they call them growth stocks back then?
oh yeah.
Okay.
And so I hooked up with Dave Dreaman, which some of your people will know Dave Dreaman. He and I hooked up, and we started our own little firm, and focusing on value PE discipline. And we got the idea from two things. One, Ben Graham gave a speech in 1975 also, and he said, you could probably forget my books, all the stuff I wrote. He says, because there's so many people doing work on the stocks today. There's like every stock's being followed by 30, 40 analysts. So he says, it's hard to get an edge. He says, so I've been fooling with something more recently, which I think makes all the sense in the world, which is a strategy I would recommend. And that was two things. One, he says, buy stocks with a discipline, low PE, low price to book, and dividend yield. And, and then be a long-term investor. 75, there's no interest on Wall Street anymore. Value was dead. Well, value was never an issue to begin with. And we tried to get excited, but there's no interest in stocks much for the whole next, 5-10 years. But all those, growth stocks eventually, just rolled over. Sort of interesting, you go back and look at IBM, peaked in 1973 at a certain level, became value stock 10 years later. It went down to 10 times earnings and a 4% dividend yield. So it took that long, even though business for IBM was good. We had done work on RCA back in the 30s. Same thing, it went up, skyrocketed, came down, was dead forever, even though everybody was buying radios, because what happens, the competition comes in. And so history, was repeating itself. And so anyway, when we wrote the book, we're writing the book for two things. We're writing we started in the book, we said, we can talk about the investment strategy. But we said, the problem is the volatility is so extreme that if someone doesn't understand that before you look at the strategy, you're not going to be distracted.
So this is the book, The Case for Long-Term Value Investing. Now, why did you write it? What motivated you?
Two things. One, we started off because value had been out of favor. So he said, well, listen, value has a great history and over any kind of market. And people should be looking at it, but people are distracted by headline news. And so I wanted to get it out in writing. And at the same time, I said, the average investor is at a huge disadvantage. The temptation to buy when things are hot and sell when things are cold is going to work against them. There's a lot of emotion in the market, not only by the individual, but institutions as well. So that brings us to all this chaos, what have you, the value strategy itself. So then we get into the book, we said, okay, the thing is volatile, extremely volatile. And one thing I'll mention, during that period, the 15-year period where the market did nothing, the Dow was flat, couldn't get through 1,000. At the same time, we didn't know it at the time, but you go back and look, the bottom 20% of stocks on a PE basis over that same time period went up 1,000%.
Wow, I'd never heard that before.
I mean, it's amazing.
That is amazing. That didn't get a lot of headlines.
So why did that happen? Well, even though the market was flat, the Dow was flat, earnings are inching up, dividends are going up, and I think earnings over that time maybe appreciated 200%. So earnings are going up, and the market finally started realizing it, but much later. But in the beginning, the multiples were contracting over that whole time period, and the market still looked expensive. And So that tells you also that even in the most extended markets, underneath, you have companies that are doing everything in their power to grow the earnings and grow the dividends. And if it pays to focus on that.
So talk about dividends and the importance of the total return in the portfolio over time.
Right now, we talk about, most of our clients are in a high dividend strategy. We're focusing on PE, we're focusing on dividend yield and dividend growth. When we started off, it was just, we were focusing on, when Dream and I were working together, we were just focusing on low PE. And what happened actually in 1990, we were overwhelmed by value stock, by financial stocks. And so 1990, value, which always gives you protection when the market goes down, the value stocks went down more than the market.
You also had the S&L crisis in the early 90s.
Yeah. And the value didn't perform like it should. It usually does well when the market goes down. And it's because we had the financial stocks in there. So we said, what can we do about that? So then we said, well, when we did the original studies, we did going back 1968, we took the PE discipline, the dividend discipline, and book value, all three of those. So even though we were focusing on the PE, we did the other two. So let's go back and look at that dividend thing. And it did just as well as the PE discipline. So we said, let's combine those things. And that reduces the downside risk a lot more. And the key is, though, there is dividend growth. You got to get the dividend growth also. You put those three things together, and that really makes the most sense. And that's where we sort of have focused in. So we came across the dividend strategy, and something else that enhanced the dividend strategy is when we did the original study on why stocks go up. Stocks go up because earnings go up. And you go back over the last 70 years, and earnings go up irregularly, but earnings go up. Earnings tend to double every 10 years. No matter what, it seems like they double every 10 years. And so we said, that's impressive. What did dividends do over that same time period? Well, they were less volatile than earnings, but they went up the same way. So we said, that's a pretty straight line. So we went back and plotted that on the market. And what we found is that of the 16 recessions you had, the dividends for the S&P 500 went up during every single down cycle. In fact, 1975, 74, 75, which was the worst one, market went down 50%, earnings went down 50%, dividends basically went up during that period. So companies, U.S. companies especially, have done a great job in trying to maintain a dividend discipline, and it's paid off. But the fact that they went up in every single recession, not some, every single one, is amazing.
That is fascinating.
The only exception was the most recent one where they had to cut the dividend. But then you snap right back.
Well, sometimes cutting a dividend can be positive for a company if it's draining a lot of cash.
Yeah, but that's,
And then the market considers that positive.
When you're looking for dividend stock, you're looking for stocks that, have good balance sheets, and they're not going to be cutting the dividend. Now, if you find a stock where they're going to cut the dividend, and it's going to change the company dramatically, and they're going to be increasing the dividends, you want that. But in general, you got to be careful what you buy.
Now, how do you get your clients to stay invested in the markets? Or do you?
That's a struggle. But one other thing, by the way, book value is one of the three disciplines. And we don't use book value that much. But the interesting thing is book value also has a great track record over the last 70 years.
And that's not one that you hear a lot about anymore.
Not at all. And I'm shocked that even the last 5 years, book value is competitive. I said, we haven't really focused on book value at all. But I think, we always use it to a certain extent with metals companies, with some very cyclical companies, that were, liquidation becomes important. But one Anglo-American was a stock we had, which owned De Beers. And we owned the stock, was listed on the European exchange, and the stock was selling at 10 times earnings, had a dividend yield of 5 or 6%. And all of a sudden you started getting bad. We had it in a high dividend strategy. And all of a sudden you started getting no debt. You started getting bad news. And the Russians were dumping diamonds on the open marketplace. Canada had this huge diamond find. stock went from, I think, 10, for 20 was the one we brought it, to 10. So we'll cut it in half. We have 5 brokerage firms that were recommending the stock, all made a strong buy on it. They all went to sell. And we're stuck with this thing, but the value was phenomenal. So book value there. We said this book value is diamonds and gold. And now it's 5 times earnings. And the yield is now, 7%. So we said, let's stick it out. Meanwhile, the stock kept going lower a bit. The other thing we're looking for is what the insider's doing. And the Oppenheimer family owned a big piece of it. So we called them. We found out, as well, we're not buying the stock right now, but we're going to hold it. So we held it for another 6 months or 9 months. And all of a sudden, they stepped in and bought the stock at 35 and drove it up 200%. And so that's the advantage. It can work.
Right. So let's talk about the markets today. And are you finding any value in the market? Because this seems to be a very growthy type of market. So how are you looking at the markets today?
Well, it never changed. One thing about, when we talk about the disciplines, what have you, the one thing when Graham said, long term, he said, when you're dealing with clients, you can't, long term, what is the long term? Is it 1 hour, 1 year, 10 years, what have you? But we started figuring the accounts on a 5-year basis. And we said, you know what, that gives you enough time to give you a full cycle.
That's a full market cycle in there.
And we went back and tracked. So we have in our book, we have all the 5-year periods from 68 on. And it just, dramatically reduces all the volatility. So as far as the market goes, we wrote a piece on bear markets and recessions. And people said, well, worry about a bear market, recession, what have you. It doesn't make any difference. I said, if you look at it, we did a report pointing out from 1968, all the 5-year sequential years, 68 up to the most recent time. Alongside of that, we put what happened to the market, bear markets and recessions. Every single 5-year period, coincidentally, had a recession or bear market, which is pretty bad. Every single period, down 50%, down 40%, what have you. Meanwhile, up every single period, double digits. And you look at that and you say, why is everybody worried about what's going on with recessions or bear markets? You can't get that right.
So what it really is about educating clients and individuals that markets go up and down.
Right.
And that if you stay invested over the long term with a discipline, in the long run, you wind up doing fine and getting good performance. Is that correct?
Yeah, yeah.
So that's kind of the whole philosophy.
I have one thing, by the way, on here. Somebody wrote a letter after. They said, you talked about comparing why, value does better than growth. And you have in there value over the 70-year period of time lined up with growth. And value does better because when growth does better, value keeps close to it. But when value does better, growth quite often is way off. And the guy said, well, you can't really call that value and growth. You could say high dividend and value, or high dividend and low PE stocks. And but I was thinking about that, so I wonder what the high PE stocks, not just the market, but the highest PE stocks do relative to the market per se, and much worse, which is surprising. So
that's in the downturns.
Every year.
Oh, in all cycles.
Time. Yeah, over the whole time period. I just looked at that this morning actually, and I said, as a response to that question, but.
So you're sticking with your value discipline.
Oh yeah, I mean you get periods where you say, well, maybe this time it's a little different, and you get certain industries, what have you, you don't know how it's going to unfold. Dramatic changes going on all the time, and our research people have to sort of figure out how does this impact. As far as portfolio strategy goes, which I think we're going to get into maybe here, is the strategy works. So what you have to be is diversified, and you don't get overweighted no matter how much you like an industry. Don't get overweighted in that. Stay diversified and try to find the most interesting stock in all the different industries you can. And you will have a tilt towards, if you're worried about the market a little bit, you'll have a tilt maybe towards less cyclicals, which we've had done for a while. Now they're saying we're all of a sudden we're in a new bull market. January, everybody was bearish. Now we're in a new bull market. And so maybe a little bit more conservative.
Are you ever out of an industry or sector?
No. Oh, sector, yes.
Sector?
An industry, yes. Yeah. Like we don't have any airlines right now. Periodically, they're so volatile. They're not investments. Now they're the ones, if you can buy them on a book. When I was at Donaldson, Lufkin and Jenrette, we had the top airlines analyst there, and he said, if you can buy the stocks at book value, or 20% under book value, then you buy them. Otherwise, they're too cyclical. And so that.
So what about sectors? Will you be out of a particular sector?
Maybe, if it depends. Yeah.
Are there any, what sectors do you like now? Are there sectors that are looking better than other sectors in your work?
Well, we have healthcare, and there's a lot of controversy with A1 with healthcare, but healthcare is still, cheap stocks, a lot of cheap stocks there. We're light on the banks right now. We have two bank stocks. We have Morgan Bank, and we have Bank in New York. Mellon Bank. And we have, I think if you're an analyst right now, the opportunity in the banks for consolidation could be phenomenal. I remember with the savings and loans all went out of business. The whole entire industry went out of business. And what happened was they had the Resolution Trust. And so what happened is all those S&Ls, they wrote them off, consolidated, packaged them, and Wall Street made a fortune on them. So the analysts probably there's going to be some interesting opportunities in the financial area.
Maybe in the regional banks you might be referring to?
Oh, yeah. And the big banks have an advantage in that people are going to be bailing out of the small banks if things get tough, and they'll go to the bigger banks.
But obviously right now you're a little bit conservative.
On that, yeah.
On that, but looking for opportunity.
Yeah, yeah.
So there's a lot of talk about technology and AI right now in the markets.
Right.
Any thoughts on technology?
Well, as far as our industry goes, as far as stock picking goes, if AI can provide us with tomorrow's prices today, that would be good. But I don't think that's going to happen. But it's going to make our industry, and a lot of industries, a lot more attractive because you're going to get more data efficient. And
you can analyze more data.
Oh, yeah. So, but still, the reason why stocks move is it's emotional as much as anything else. And
well, you probably remember Wall Street when there were no computers.
Yeah.
Right?
Yeah.
You probably remember a ticker tape.
I remember I worked this summer, and for Metropolitan Life, my uncle was the head actuary there. And they had a thing called UNIVAC, which was the first real high-end fast computer. And I said, wow, I want to see UNIVAC. What is it like? It was just like a closet with this thing in it. Yeah.
So you've seen dramatic technology change on Wall Street.
I still have a slide rule, which I don't use, of course.
The old way of doing your calculations, right?
My grandson said, what the hell is that thing?
So what do you tell your grandson about markets today when he's looking at your slide ruler?
Save money and invest, and but don't get, don't do anything. The key to, and I have in the book, at the end of the book, Andrew said, for young people, the paper boy, save a couple bucks, put it aside, don't touch it, let it grow. And we have not only the paper boy, but when I was at Donaldson, Lufkin and Jenrette, I had some surgeons in Florida. These guys were making big money in those days. And they had all kinds of money throwing around. They were buying restaurants, and they were buying hotels, and they were buying, jet planes and boats and what have you, getting married 2 or 3 times, buying a nightclub, they were spending money like crazy. But one of the doctors I worked with had them focus on their IRA plans. And they could put, I think, $25,000 each in these IRA plans. So they did that. And all of a sudden, they got to be a little bigger, and so they said, we're going to tap them. He said, don't touch those things, don't touch them. They never did. So some of those guys are all now 90 years old. But all of a sudden, they had 30, 40 million in this IRA account. And because
that's the compounding, that's the dividends and reinvesting.
And meanwhile, as far as, even though they're making big money as they went along, they have not much else. That's 90% of what they have when they're right now.
So the key is not to touch your money.
Yeah.
You have to leave it invested.
Yeah, and have money to play with, and have other money, but take a certain amount, whatever is affordable, put away and look at it. I
I
remember
think-
my mother had a Christmas club. Remember people put away.
Yep, I
Get a
remember
little
the Christmas
envelope,
club, the
you
little
put money-
envelopes with the, yes, I do remember
But
that.
putting money away is the key, and it's,
I think when we were talking the other day, you were telling me that you had two different clients that invested at the same time.
oh yeah.
One never touched his money, and the other one used to get nervous and take money out.
That was on market timing. You asked me about market timing.
Yes. So what about market timing?
And these were two people that came in, very high profile. You'd know the names of both people. And one of them would come in after 20 years. Every week, every year, one person would come in, we have lunch one day, and that was it. Never touched the account. The other, periodically, very savvy person, would say, hey, Jim, give me 25% out of the market. I don't like this way the market looked. 9/11, they got 30, 40% out, but then came back in later on. And so I said, well, how about, what's the difference in performance there? And I sat down and I said, because just looking at the accounts, it looked like there was a difference. The one account who never touched it was up 1,000% over the time period. And the other account who made a couple small moves, which seemed like it wouldn't make that much of a difference, was all half of that.
So 500%.
Yep. Yep.
That's a significant difference between 1,000
And one of the
and
reasons
500.
we get in here in the book a little bit, when you get recessions and bear markets, you never get that timing right because all of a sudden it always lasts a little longer. You know, can't get the bottom. When stocks hit the bottom, it looks like it's easy. It comes off the bottom, but it may stay on the bottom for a year, or it may make another bottom on average. So it's confused. But once stocks make a bottom, the performance the next year or two is phenomenal. In fact, if you took that away from performance, the market would be flat over the same time period. So in other words, you don't want to miss that
Right.
recovery period.
So do you look at the international markets and have anything in international exposure?
I
in
got
your
an interesting
portfolios?
question out of the blue. So you were in the Navy. What did you learn from the Navy and how that helped you on Wall Street? I said, I never really thought about it that much. But but because we traveled all over the world, basically, you did think more international. And Wall Street wasn't very international when I started, 65. And like one of the first stocks we bought was Jaguar. Jaguar was a spin-off from British Leland. I mean, it was a foreign stock.
We certainly know the cars here.
Yeah. And
but it's an international company.
the stock was selling like $2 a share, and all of a sudden, Ford finally bought it at $15 a share. But and we also so all of a sudden we got also very interested in the emerging markets. What was going on with the emerging markets? We had Procter & Gamble was selling at 25 times earnings. Unilever was selling at 10 times earnings. Basically, a lot of the same businesses. But Unilever had been in Indonesia, for instance, for over 100 years. So they were going to be able to outcompete, with Procter & Gamble. But Procter & Gamble had the multiple. And so we did we were on CNBC, I think it was, and they asked us, what are your three favorite stocks? And Unilever was one of the three. And I said, well, everybody hates Unilever because it's, slow growth and stodgy company and management's not very creative. And, but what we see is that the international business, which is only 5% of the business, is showing great opportunity, great growth. And that's growing 2 or 3 times faster than everything else. So even though it's only 5%, it's not showing up yet. And so we got a call like 3 or 4 days later from Unilever. And they said, by the way, stodgy management, boring management, wants to come over and tell you about our boring products, what have you. So they flew over. They took our boardroom tables like this. They filled it up with all the different products they had. And they went product after product after product, how they were taking these different products that everybody assumed it was the U.S. market and catering it to the foreign markets. Like they had Dove soap, for instance. We have in the U.S. you get a big thing of Dove soap because it's cheaper, right? But if you're in Indonesia and you have to walk 2 miles to do the wash, you want something like a 6-pack you can snap off and put the soap in your pocket and carry it. And that was a classic example of product after product after product. Jennifer Chang, who was our research director at the time, now she's a portfolio manager, and but she was going to China to visit relatives over there. And she went over there, Lipton tea. At that point, everybody had the modern Lipton tea from all over the place. Lipton tea was not the tea that anybody used. All the restaurants had high-end tea. And she went over, but she says, well, Lipton tea created a product for the Chinese. Chinese like their tea cold, And they like the package small, so they had these packages of small Lipton tea packages, and it was the hottest thing going. She says her uncle had a freezer located loaded with these things, different market for different countries.
So you do add some
So
international
anyway,
exposure when it's appropriate.
also, when we started the high dividend strategy, getting what we're looking for with the high dividend growth, we were having a hard time finding names where you get yield, but you couldn't get the dividend growth. You include international, dramatically expands the universe you're picking from. So then that's when we really started using the international stocks broadly, more than just Jaguar and a few others. And so that gave you a whole lot of new names to pick from. And that's what like our high dividend strategy, the average dividend growth over that for the last 5 or 10 years has been 10% a year. So that's the
pretty
thing we're
high.
focusing on, yeah.
That's pretty high. Do you have a sell discipline?
Sell discipline is when we're looking to buy, right now, for instance, we're looking to buy stocks in the bottom 20% on a PE basis. That's always the case. So right now it's 12 times earnings or less in that area. And because the market's moved up now, probably the average is 14 times earnings. The market's around 18 times earnings. That's the normal spread probably. But when things get over, you buy something, it gets over the market multiple, would say over 20 times earnings. So something gets up to 20, 25 times earnings. We look to replace it with something that's cheaper again. We don't necessarily do it that hour, but we look to replace it. So it gets on our list. An example, which is another example of the growth stocks, by the way, Microsoft. Microsoft peaked at 2000, like 30 times earnings or 40 times earnings. 14 years later, we were able to buy it 10 times earnings with a 4% dividend yield. Hard to believe it took that long to get down there. Business for Microsoft been phenomenal all the way through, but just wasn't as good, and the multiple was too high.
Sounded like the Nifty 50 stocks.
Same thing all over again. Now what's going on with now is
With
a little bit.
what do you think
Well,
about
what you're
the
starting to see is-
concentration with the stocks
Well, you're starting to
today?
see competition. I mean, they're all getting in. Netflix, all of a sudden, everybody's, Netflix had a corner on the market. All of a sudden, they're getting a lot of competition. So what happens is they start competing. The same thing happens all the time. They take out the weak players are gone. So then the big players, they can only grow their business so much. What do they do to continue the growth? They get stuck. They can't figure out how to grow it. And so they have to come up with either new products or get in somebody else's business. And that's what happens every single cycle. And that's what's happening here. And
So what phase? We're still in the phase that these stocks are still going up. So you're saying eventually they'll probably run into
yeah, if you look at the highs on some of
growth.
these stocks, they sort of rolled over some of them. And you have these new AI stocks are now making new highs, what have you. So you got two things sort of going on. But
So with AI and technology stocks doing really, really well, does this kind of remind you of the Nifty 50s all over again?
yeah, very much. Actually, we haven't sold, by the way, I talked to Microsoft before. We talk about sell discipline also, getting back to that. We've sold that stock cut in half. When the stocks get over market multiple, we look to either, sell completely or sell at least half. We've sold that half of that about 4 times, 5 times. So we still have a small position in that as a technology company. And so anyway, we're the research people, that's what they're looking for, is to add to names that benefit or don't benefit from the.
So I think we're getting close to the end here in our interview. This has really been a great discussion, certainly great history in markets. You have a real great depth of knowledge about the history of markets. And you invest with the discipline, and that's what you wrote about in the book. Long-term investing goes a long way to reduce volatility from year to year, as you talked about. What advice, if you were talking to a young person today, what advice would you be giving them on how to invest in markets?
Well, what I'm talking about, is putting money away and then basically buy into a value fund and let it grow and just,
And don't touch it.
yeah. And if they want to play with something else, betting and what have you, they can do that.
Have a different account though.
Right, yeah.
But keep that one account that you don't touch,
Yeah.
and keep it growing over time. Is there any other advice that you would like to give to our audience, that anybody that's interested in coming to Wall Street, that you would like to share?
Well, coming to Wall Street, I don't know. That's
Well, you've spent 60 years plus.
Well, when I came, it was a whole different world. It was a lot of small companies and what have you. I did mention back, by the way, in the book in 1975, there was an underwriting for American Motors during that period. And there was what they call tombstone, which all the people in the underwriting were listed in the group. And there must have been 30, 40 companies there. 2 years later, they were all gone. Either sold out for 5 cents on the dollar or went bankrupt. A couple of my old companies went. Actually, Merrill Lynch went out the last time, really, basically. So it's amazing how tough the business is.
It's a tough business, which means that's why you also want to have a diversified portfolio,
And
correct?
be disciplined. Yeah.
And be disciplined.
Yeah.
That's terrific advice. I really want to thank you so much for joining us
Okay,
here
thanks.
today. It's really been a wonderful discussion.
Thanks for having me. Thanks a lot.
Thanks.
Okay.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisory services offered through Sanctuary Advisors, LLC, an SEC-registered investment advisor. Sanctuary Securities, Inc. and Sanctuary Advisors, LLC are wholly owned subsidiaries of Sanctuary Wealth Group, LLC. This podcast is for general and informational purposes only and not intended to constitute investment advice. Any stocks mentioned were to discuss market trends and our recommendations to buy or sell any security. The opinions and views constitute our judgments as of the date of production and subject to change at any time. All investing is subject to market risk, including loss of principal and not suitable for all investors. Past performance is not a guarantee of future results, and there is no guarantee any investment strategy will achieve its objectives.